Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, March 24th, 2023. S&P 500 currently sitting at 39.51. I'm David Zarling. I'm here with Spring Break aficionado Pratty Tulsian and Ian Joe Pesci McMillan. Always something to cover in the markets, even though we're sitting in the middle of a 20% range that goes back to May of 2022. It's almost 10 months of a market that's gone everywhere but nowhere. A large 20% range that we haven't seen since the mid 1970s. If they don't scare you out, they wear you out. Where would you guys like to start today?
I'm worn out.
That's fair. The market does a good job of pulling in buyers and sellers, right? It's a liquidity instrument. And so it's something that impacts supply and demand to bring in buyers and sellers to meet at a price. And when you have a low liquidity environment, this is what you see price do. And so you've seen this wide range in a variety of instruments, whether it's the Russell 2000, NASDAQ 100, S&P 500, which we talk about frequently, a large range going back 10 months. And now we have flat 200-day moving averages available and showing up, which we all know signifies trendlessness. So the last 10 months has been trendless. And that's the new trend. Can the trend of trendlessness continue?
Yeah, I was just peeking ahead to the monthly candle, and March's monthly candle so far is a doji. We've basically gone nowhere since the start of the month, yet so much has happened in the last 24 days.
A doji, of course.
No, that's a great point. And what is the size of that doji? So for our listeners who might not be familiar with that term, a doji is a measurement using a price candle on a chart, and you will have an opening price. Price moves either lower or higher, and then close very near the opening price. So March 1st price on using S&P 500 cash was approximately 39.63. We're currently sitting at 39.54. However, we saw a high of 40.78 and a low of 38.08, and that's a pretty decent sized range. That's 7% range within this 20% range. That's a great eye there, Pratty. Now we're 1 week away from closing that candle out, but even this month has matched what we've seen in the past.
That's a 7% range since March started?
Correct.
Feels like it.
And dojis signify indecision. So we have an indecisive market. You know, if we were to maybe look at a 3-month candle or something that's larger, we have these pretty big upper shadows that go back to
Russell's in a 13% range
for the monthly on a monthly basis.
For March.
Yeah, pretty large.
And quite red, quite a big red candle. I know Pratty said the S&P was a doji, but the Russell and the Dow a little bit more. Russell, very large red candle. Dow, a little bit larger body there.
To the downside. And that reflects that relative weakness out of small caps, which I know Pratty, last time we had you on, you know, there was talk of if small caps could break a certain level versus the S&P on a relative basis, that would be very healthy and indicative of broadening out of the market. And that since has not taken place. And so that's kind of a warning sign, correct?
Yeah, it's interesting to see. You know, I definitely didn't have new relative lows for small caps on my radar for 2023. Just at the start of this month, you know, on March 1st, IWM versus S&P made a new high. And then, you know, as of yesterday's close, we were sitting at a new low. So, yeah, markets move fast.
And I think micro caps, you bring that up, that March 1st. Micro not there, but earlier in the year, back in February, micro caps. So maybe a small divergence there, but I think that's a great point. March 1st. I mean, I'm pretty sure I bought small caps, breaking on a relative basis. That's a great chart. And yes, to Pratty's point, how quickly things fall apart within 2 to 3 weeks.
Pretty massive rotation in the relationship between growth and value, the relationship between large and small, the relationship between tech and financials. And you can see that throughout the charts that it's not that on an absolute basis tech has gone gangbusters, but it's done much better on a relative basis than small caps, which are ad nauseum. We talked about this, highly indicative of what we've seen out of financials and specifically the banking sector, whether it's here domestically or internationally. And that has an impact, the financials being a big portion of small caps, banks as well, seeing that weakness. And that's really reflective last week. I know people get sick of last week on the podcast going solo. I went through the deterioration in the percentage of stocks above their 200-day and their 50-day across whether it was the S&P 500 or the NYSE. And it was very apparent that from the end of January through last week, we've seen a deterioration in breadth, and that only continued this week. Is it fair to say that that's a continuation this week? Is that it's not like breadth stabilized? We've actually seen a weakening of breadth even this week compared to last week.
Yeah, I would agree with that. One of the measurements we've been tracking here internally is the percent of stocks that are below their October lows, and this week that ratio is expanded. It's sitting at around 30% right now. So back in December, you only had about 20% of stocks below the October lows, and I'm defining the October lows kind of as somewhere between the end of September and November 10th. So whatever the lowest price was for all U.S. stocks with a market cap greater than 300 million, and about 20% of them were below the October low back in December. And as of yesterday's close, about 30% are below their October lows. So we've definitely seen more stocks break down and make new lows. And what's interesting is about 27% of those names that are making new lows are financials.
Yeah, pretty hard hit area. And our listeners are very familiar with the coverage that's been given in the media to whether it's Silicon Valley being put in receivership or Signature Bank being put into receivership. Most recently, UBS over in Europe having to swallow up or buy Credit Suisse. And so the banking narrative or the struggle with banking stocks continues. And until price confirms otherwise, we're seeing that confirmed. Yeah. Whether you look at something like KRE or anything international.
Well, look at the monthly candle on FRC,
First Republic Bank. And that's, one that's been identified as something that's a potential issue. I mean, that's down 89% in 1 week. Record lows. And that's even after, from a fundamental perspective, other banks had stepped in and pledged deposits to them or collateral to them to help boost their ratios. So we'll see how this all plays out. I think it's fair to say, though, that banking, KRE, using KRE and some of the other metrics that we can measure is not out of the woods. That's still a high risk tail event that we could see unfold. And,
right, and to your point, financials, we take an XLF. Is it the highest weighted sector? No. Is it an important sector? Yeah.
Yeah, it's one of those sectors you want to see.
And a lot of it is, yes, clearly there's lots of sub industries. A lot of it, when we think about financial sector, where does your brain go first? Banks. And so banks weigh on financials, and financials weigh on the overall market. There's certainly, I put it in the category of, do financials need to always be outperforming? No. Do they need to be in an uptrend for a healthy market? Yeah. I mean, I would put them in that category. And, again, we're looking at an XLF. Are we going to find support here in the, let's call it $30 to $31 range.
And why is that so important? Why is the $30 level?
Well, it's where we found support last summer, and it's where we found support, in October using Pratty's time frame. So $30, below this. It's also, 31 was the pre-COVID highs. So this entire, where we're at now is a very, no pun intended, but a very make or break situation for financial stocks in general.
Well, and
a lot of this banks get the headlines, of course, but a lot of this has spilled over to insurance as well.
That's correct. And when you look at XLF, you brought up the pre-COVID highs. It's also where the 2018 highs were, and it's the 2007, 2008 highs. So it's this massive area of what we would call polarity, where supply and demand interact and price reacts and goes directionally one way or another. And so if XLF is going to be below $30, that's probably going to be very indicative of an environment of an overall market that's struggling, right? We talk about transportation stocks, we talk about semiconductors, right? Transportation stocks, very intuitive what we're talking about there, things that transport goods. Semiconductors are transporting digital goods. Financials are simply transporting cash in different directions. And if you have a lockup in financials, just like if you had issues with semiconductors or transportation, that's an issue. And here we have an environment where banks are 8.7% of small caps. That's going to be a problem for small caps going forward. And small caps are almost where they were at their October lows.
They are. Micro caps actually to new lows.
Yeah, micro caps, the smaller, which
if we take the smallest of the smallest micro caps, especially on a weekly basis, stocks for the most part are pretty flat today. Micro caps a little red. So again, sitting right at pre-COVID highs, technically below. You're below your 2018 highs, which of course has been the midpoint of this entire range we've sit in. And I'm looking at something like IWC.
Yep.
But and this goes, to add to Pratty's data on breadth, when you see in Russell 2000 or micro caps or RSP not to new lows yet, but.
And what is RSP?
RSP is equally weighted.
Okay, so S&P 500, not
the average stock in the S&P, trying to kind of curb out what Apple has done for the broad market over the last couple weeks. Very, very weak. And so we had RSP strength, very strong. RSP had been beating the S&P since May 2020, right? Strong relative uptrend. Yeah, there's some relative downtrends in there. But overall, the average stock had been good. This is good for breadth. Back in January, a breakout to new highs. And that coincided with a lot of other very positive breadth measurements that are going on. I think bullish percent flipped around that time within maybe a week of that. So there are lots of very positive things going on as far as the breadth narrative was concerned in January. And
January is when we recorded 3 major breadth thrusts: the Whaley breadth thrust, the breakaway momentum, and the 770 breadth thrusts, which we hadn't recorded since the 70s. And now what February and March has done is potentially, it's the worst response that we've seen to those type of measurements.
And it really is. And I made, maybe somewhat facetiously, but made a comment about, and people have shared great data. There have also been, between January and February, so many signals that truly were, I'm not saying that the samples were massive, but we're talking about 6 of 6 or an 8 of, there were lots of very strong thrusts given that had occurred on a few instances over the last 20, 30, 40 years. Very strong, had very low sample sizes, but also basically zero failure rates. And that triggered in January and February, as I said, and those are all on the cusp of being wiped out.
So
all of the evidence from January and February that said this is turning into a healthier market has taken a big step backwards.
Well, and this goes back to market characteristics. We didn't know that there was going to be a 20% sideways range starting in May of last year, but we now know that that's the case. We also didn't know that we were going to see this sloshing around of breadth of the amount of 90% up days followed by 90% down days during that period has been abundant.
Yes. And
so the market characteristic of sideways massive chop, which is hard on any trend following process, including the adaptive one, that's part of markets, and it's a part of staying disciplined to a process, because out of this range directionally we're going to go one way or another, but also open to the idea that you could have more months ahead of sideways.
Dave, I don't know why you would put that out there.
Well, I put that out there because when you look at
it's a non-zero probability, right?
Right, it's non-zero, and the amount of people that are trying to short this market fully, like be heavily involved. You look at ETFs that are inverse to the S&P 500, they're at the same level of AUM, which means inflows of money coming into a bearish 3x S&P fund that we saw back in October. It's not till you see the shorts wear out that anything to the downside can happen. It's almost, the way I would describe it is, there's so much shorting that it's kind of hard for the market to move lower. Now, that's with a caveat, because you saw an increase in shorting in other pretty big bear markets, whether it's 08 or 2000, the most recent big ones. There was increased shorting going into the final leg as well, and that it really didn't necessarily hold up the market. But all these short buyers are our future buyers. And so could you see an environment where, because there's so much betting against the market, that the market actually just stays in this range? It's absolutely a possibility. And it sounds terrible because, right, the past 10 months hasn't been great due to the 20% swings and whipsaw nature of things. And if you don't use charts, it could be very disorienting. Like if you deal with loss aversion, so loss aversion being that losing $100 feels worse than equivalently to $100 gain. If all price is doing is going between those $200 levels, it feels terrible because of loss aversion.
I wish someone had told me last summer that I'd be on my third 2-week vacation. Someone had told me this is what we were going into.
Right. Scare you out, wear you out. Minus 25% and then move sideways in a 20% range,
and it goes back to, right, and there's a lot of context. Okay, so where was a majority of the shorting? What were your opportunities in 2022 as far as getting short? And I would argue you had the early April rollover,
and that's, I guess, that's
and then the mid-August, right into the 200-day. But other than that, this was not and has not been, outside of basically 2-3 week stretches over the last 14 months. It's not been, we're in a downtrend, but it has not been a consistent, what's the best way to put this? It hasn't been a prevalent trend.
Well, it's been trendless. Like as soon as the breakdown,
it's to the downside, but it is, again, outside of a couple of these periods where markets were down, 18% in a few weeks.
Well, we don't have, let me paint this picture. You don't have a declining combination of a 50-day and 200-day until May of 2022.
And by then it's over.
And by May of 2022, you've broken, or late April, you've broken important horizontal levels. So that's when the downtrend is confirmed.
Yeah.
So from that point, when the downtrend is confirmed, you have a 20% range, and we're still only minus 3% from that point. So it's not like short sellers have made out. Short sellers have also gotten crushed because they've experienced the same type of chop and might even be worse off if they had a certain bias going in. But the market environment going back to May of 2022 is one of the harder ones on record, going back to the 1970s. And it messes with long only, short only, trend following. Everybody has paid a premium to be involved in the market for the past, I would argue, since February of 2021. And so kind of pivoting back to you, Pratty, about the dynamic measurements, you talked about the increase of stocks exceeding their October lows to the downside and financials representing almost a third of them. What about the flip side? So we know October as being an important, or a low that took place in the S&P 500, the NASDAQ, small caps. From that point forward, are we seeing that amount of stocks rallying increase off those lows, or is that what's the case there?
So not really. If you consider like October 13th through December 15th as kind of the initial rally off the lows, and if you look at the percent of stocks that are above that level, that percentage has come in a good amount, and it hasn't bounced despite despite the S&P at least having bounced over the last 2 weeks. So that number is kind of sitting right around 25%. At one point in February, you had almost 50% of stocks above that initial high, but again, it's deteriorated back down to around 25%, and that's where it's been sitting, even though the S&P bounced. And again, that's just reflective of the weakness in small caps and how NASDAQ heavy names have either held up or even grinded higher in some cases.
Right. In some ways, you could say it feels a little bit like the flight to safety we saw during, I don't want to be too bearish, but the flight to safety that we saw during the COVID crash, it definitely went towards tech and growth during that period. It has
I
the
would say
same features.
That's very, very similar, especially if you look at QQQ IWM, that ratio, the way it broke out on March 9th, and it moved up almost about 15% over a 10-day period. That's a pretty significant move, and that's not something we've really seen since March 2020.
Yeah. And what are we seeing out of other, we're all familiar with the long duration bonds, treasury bonds, you name it, that isn't a T-bill or a short-term commercial paper, has been in a correction as well, right? The demise of the 60-40 portfolio, which has been heavily covered on this podcast. Ian, are there any changes in characteristic there as far as, because I'm thinking back to, you mentioned micro caps breaking down on a relative basis on an absolute, and I think of micro caps as like, that's a risk on area, meaning, hey, if things are well in the market, we're going to take on more risk, and it could be in micro caps. We're not seeing that.
Yeah, they're at least in an uptrend.
Right. And then I think of, so that's in one column as far as being risk off. On a risk on column would be how well semiconductors are holding up. Are there anything in the risk on or risk off columns that you are looking at?
You got to give it to semiconductors.
Okay.
Now, is this also a jump to, this fits in the tech bucket, this fits in the, well, right, we know that Apple and Microsoft aren't going bankrupt, so I can hide out there. Or we know NVIDIA is a higher growth, quote unquote, name. Can we hide out there? I give it to semiconductors. Another area that I would put in the risk on would be the Thing Plus, right? Tech in general.
So you're talking like your Facebook.
Yeah, and they just swapped out Twitter for AMD and swapped out, I can't think, but I know the other replacement was Snowflake.
Oh, they replaced two in the FANG index.
I want to say it was Baidu, but that might be wrong. There were two Chinese names in there, Baba and Baidu, I believe.
Okay.
I want to say one of them got replaced. I know Snowflake is now in there. And I know AMD is now in there. And obviously Twitter's gone. But anyways, yeah, those areas that catch a lot of that. I mean, NVIDIA, I don't know what you have to be a mega cap at this point, but I assume it's knocking on the door. It's 650 billion. So I think it falls into that. Just again, as Pratty said, this flight to mega and large cap tech safety, which with the way the rest of the market is acting, yeah, it would. At a lot of other instances, it would be risk on, and I'm not convinced that this time it is. Again, to your guys' point, what we saw in March 2020.
Well, that's an interesting identification too about NVIDIA, because NVIDIA now is the fourth largest holding in S&P.
Wow. So it's getting up there to mega. I mean, that's mega cap status.
That's mega cap status. And like you look at like unique or a thematic ETF like cars, like CARZ, which is an ETF that's supposed to be, kind of the future of driving technology.
Yep.
And NVIDIA is like the largest piece in there. And so that ETF has really held up well. Well, it's because of that mega cap name that's in there now, NVIDIA. So it's fascinating because it just passed up Google as being in that fourth spot.
Wow.
And so if we look at semiconductors, like, a familiar one like SMH, it's the largest weighting, which it is, which that means it just surpassed. Remember when Taiwan Semiconductors was SMH?
Yes.
And so now we have NVIDIA first place at 13.5% of SMH.
Wow, that's huge.
And that helps, right? That particular stock. So if you, maybe a way to summarize this, and you guys push back because that's your job, is to push back on me. The move we've seen in equities since the breath thrust in January. So since the end of January through now, we've seen the majority of stocks correct, even to the point where there's a greater amount of stocks, an increasing amount of stocks that are below their October low. If it weren't for Apple and Microsoft, Google, and NVIDIA, right? Because NVIDIA is masking some things for semiconductors. Now, there's definitely some other semiconductor stocks that are fine.
There are.
But there's some serious masking of what's going on underneath the surface with those four names. Is that a fair summary?
Yeah.
Is that there's some...
I think the snowball just continues to build. These are super overweight names. And when you think about what they can do, if they hold up well, it's very hard from a 30,000 bird's eye view. If you're someone that just tunes into CNBC to see where the market closed, I think they do mask a lot of the damage that continues to go on. I mean, back to a date you pointed out, February 2021.
Right.
There's still cracks in the foundation that continue to expand.
Right. And there's a pretty wide dispersion. You look at Apple versus, I know you shared a chart, Apple versus microcaps.
Yeah.
You look at Apple versus small caps, brand new all-time highs this week.
All of that. I mean, just right there is a perfect example of breadth. Of you've got this one stock that continues to have such an overwhelming impact on everything else.
Yep. And I would say it's between Apple, Microsoft, and NVIDIA. Even Google's held up pretty good.
It has.
But it's definitely a mega cap. You've got this one segment, the generals on the field, if
Meta.
you will.
I guess you can throw Meta right now. That helps out more communication services than tech, I believe.
Well,
But Meta,
communication services is the best performing sector over the past month.
there you go. And you've got, wow, I can't believe NVIDIA is actually bigger than Facebook now, or Meta, whatever. But from a market cap perspective,
and even bigger than Google.
Mm.
Pratty, I didn't have that on my scorecard for 2023 either.
No, I didn't either. And I mean, I'm just looking at S&P versus, semiconductors versus S&P. So SMH divided by SPX. And this is coming back up to a level that we've looked at in the past a while ago, back in late 2021. This is where semiconductors peaked relative to the market in 2000. And they're back to that level. If we get above there, does the snowballing continue even more?
Right. Well, that's a great point, because that goes back to a chart, and forgive me because I can't remember actually who shared it. Ian, I know you shared it internally, and it was just basically adding Apple and Microsoft together as a percentage of the S&P 500, and we're at a new high for that. Correct?
I think that was from Bespoke, and yes.
So that's a new high, and I can't remember that percentage, but I guess back of the napkin, if you were just to look at the S&P 500, the fact that Apple and Microsoft equal approximately, let's call it 13%. That's two stocks.
Believe that's where it's at. It's in the 13 to 14 because it used to be around 11ish. So and now it's up to the 13. It kind of went through this range. Now it's up. I believe you're around there. Yep.
So you've got an environment where Apple and Microsoft are covering the sins of financials, right? Because financials as a sector are 13% of the S&P 500. Apple and Microsoft are 13% of the S&P 500. And those two things, the Apple and Microsoft offset.
About 13.5%.
Right.
Okay. Yeah.
So the Apple and Microsoft scenario is covering up what's happening underneath the surface, which you can't hide in small caps.
And you can't hide that in RSP.
Right. Equal weight. Right. Equal weight. So it is an environment of mega cap. It's an environment of deteriorating breadth. It's supposed to be an environment where we're seeing seasonality, right? February is supposed to be the worst of the 6 months. March is this big. It's really interesting once Pratty pointed out that doji, that indecision or that huge range that we're seeing now. The month's not over, but that's how this week is shaping up too. You have a doji within a doji. You've got this week shaping up to be a doji of indecision of about a 4% range in the S&P. On the month, it's about
extra amount of fun being thrown out.
Right. And it's happening right in the middle of this range. The range,
so much fun. So much fun.
Yeah, the range that goes back to May of 2022. And so it's an interesting market environment. And when I was thinking about the columns of risk on versus risk off, we're seeing some things that, I think of bonds, right? Bonds typically had been something you would buy in a risk off scenario. That hasn't been the case for over 2 years. But we're starting to see that again. Do you guys want to touch base on that treasuries are starting to, I think they're just acting different than they had been for the past 2 years.
Yeah, for sure. They, bonds, while they haven't made any type of huge move to the upside, maybe finally acting as a risk off at what a lot of people thought was going to happen last year, the rush to treasuries. So bottomed in October, I guess around the same time, quote unquote, stocks did. Now, as Pratty shared, 30% of stocks are below their October lows, but bonds, if I'm looking at TLT, so we'll say the most sensitive to interest rates.
Well, we should talk about interest rates too. I mean, they go hand in hand.
They should. but bonds have held up pretty well. I mean, we're the same spot we were late November. And from a price perspective, TLT above, it's a pretty healthy base that seems to have been built. I think if you're above 108, 109, like 110-ish, 112, if you want to go back to the Q4 18 lows. But there seems to be some demand growing there. Again, when we talk about demand versus supply.
Well, and it's interesting because the inverted yield curve is something that's been a conversation piece going on for months now. And we just saw a massive move to the uninversion side over the past few weeks, matching this move out of financials, right? We're seeing this move out of financials to the downside. We're seeing an uninversion out of the relationship of like a 10-year versus 2-year yield.
Which is typically when the pain is supposed to start.
Right. And so is this time different? So on one hand, so if I can step back again and paint this picture, you have an uninverting yield curve, which for the past, let's call it 30 years, has been indicative of a recession starting and a liquidity crunch or maybe some type of credit issue. Yet you look at the early 1980s and you had some of this, and that was at a pivotal time, a change in the interest rate cycle, and you had stocks move higher from there.
This was when?
Early 1980s. You had
early 1980s. You got it started at uninvert,
right,
and stocks moved higher,
right.
Okay.
So, and that happened to be coincident, or maybe not. Maybe we shouldn't say coincident. It should be put in the category of meaningfulness. That was happening at the change in the interest rate cycle, right? That was high interest rates back then. We're talking about 17, 18% mortgages.
Well, and see, this goes back to, I love that you brought this up because it goes back to my point of, I think a lot of these relationships are going to get screwed up when we go into a new interest rate cycle.
Correct. You're going to have this massive volatility, which is what we're seeing underneath the surface. This big, I mean, think about the dispersion and the move between value and growth, large and small, tech versus financials that you've seen over the past month. That's another way of describing volatility, is massive dispersion, the difference between one thing and another.
So much rotation.
And is it just me, or everybody and grandma knows, quote unquote, knows that a recession is going to happen, quote unquote, knows we're going to have a banking crisis, quote unquote, knows that inflation is going to be a problem? Like, how many people are short?
Oh, I know a handful of people that are, of peers that are very negative. These are people outside of finance. They have nothing to do with, they don't follow the stock market for a living. Don't do anything that we do for a living. Totally other professions. And they're adamant that the economy and stocks are going lower.
And so typically when everybody's on one side of the boat, that's not really how it pans out, especially when you consider the majority of stocks have been in a correction since February of 2021. So you've got a 2-year plus correction happening underneath the surface. The broad indices have been in a correction since the beginning of 2022. We've been in a sideways correction, trendlessness, since May of 2022. So my argument would be that we're closer to a bottom in time. I'm not saying we're close to a bottom in price, close to a bottom in time. That, yes, could we see one final flush lower? That, because remember, we talked about that several podcasts ago, that is there going to be one more sentiment flush where, so envision.
And I feel like the Elliott wave thesis kind of goes along with that.
Right. One more really rapid move, leg three of
Your
three.
October 08.
Right. Really fast move. Everybody is confident this is the end of the world.
Or October 08, December 18. Yeah.
You know, it's kind of like stepping in the ring with Mike Tyson. You've been beat up a little bit and he's still standing there. If you have a fast move flush to the downside, the amount of anxiety and panic right? Because that would be what everybody predicted. See, I knew it. I knew that was going to happen. So if we do in fact have a move, and we'll only know that if S&P 500, for example, is below its December or its late December, early January swing low, which is around 3780, that would be confirmation of that. If we were to get that, that probably would mark whenever that stops, that would mark the bottom in time. And I know that sounds unique to say it that way, but based on the evidence of how long this correction has taken, both underneath the surface and even broad indice wise, and then seeing some of these other pieces that are showing strength, that you could see a scenario unfold that if we do get a flush lower, that would mark the bottom and we move higher from there. Or because everybody is short right now, we have a longer process playing out where we move higher to squeeze out the shorts and then eventually lower going into 2024. You have to be open to all these scenarios.
That is true.
But we've seen bonds catch a bid, rates.
Bonds, I want to say this. Bonds also, we talk about this May 2022. And you look at something, okay, so if we go shorter term on the spectrum, 10-year bonds, 10-year treasuries, intermediate 7 to 10 year. I mean, also basically sideways since summer of last year. I mean, bonds sideways since June 2022. It's only a month later. So a lot of indecision there. You've got a 200-day that's starting to flat out. I mean, we all know the downtrend that bonds have been in, and you've got some 200 days that are starting to potentially flatten out. Again, just another example of truly the indecision across a lot of assets. Bitcoin sideways since when? May of 2022. Gold sideways since March, April 2022. Really sideways since, August 2020. So pick an asset, oil, sideways since, now we've had a drawdown, recently, but coming out of a range that was sideways since September through March. 6-7 months.
Well, and is oil going to be the canary in the coal mine there?
Yeah. And, and I pose this question. So at what point is now this, we don't make money off content creation, and nor do we stand on a macro soapbox. But I am curious as to when the narrative will flip from, lower oil is so great for inflation numbers, to lower oil demand is because there's less global economic growth.
Yeah, that you went from inflation to disinflation to actual deflation.
Yeah.
Based on that type of environment. And that brings up a good relationship question that I'm wondering Pratty's input on, which is stocks versus bonds versus commodities. When we look at whether it's economic cycles or stock market cycles, is there a way you can wrap a bow on those relationships, Pratty?
Yeah, I mean, we've discussed before with the business cycle, near the end of it, you'll typically see, you'll first start to see bonds go down, then stocks join bonds lower, and then eventually commodities, bonds, and stocks are all going lower. And I'd say, that's probably where we were recently, and that's stage 6. And so the question is, are we moving towards stage 1 and stage 2? And stage 1 would be bonds move up while stocks and commodities lower. And in order to measure that, one way you could do so is by looking at the relationship between bonds and commodities. So if you look at something like IEF divided by DBC, or even TLT divided by DBC, you'll see these basing formations very similar to what you would see if you just looked at bonds on an absolute basis. They've stopped going down. IEF versus DBC is actually broken out a little bit. And so if these relationships move above their necklines, I think that would be evidence towards, moving towards stage 1. and maybe even stage 2 eventually.
So stage 1, to paint the picture, would be the final piece of contraction in the cycle. So a move, stocks continue to move lower, bonds move higher, commodities lower, and that's that final salvo, which would that be all that surprising considering what we've seen over the past 2 years? Because you're right, we've seen, it wasn't until, what was it, March of last year, you use something like DBC, that we started to see, let's call it actually the summertime, June, July, when commodities rolled over. And that was identifying that we're entering stage 6. You're just saying we could be finishing stage 6. If bonds pick up here based on these relationships, we're in stage 1, where bonds are higher, commodities and stocks are lower, and it's the final piece of contraction. And it's not until we see stocks turn back up that we'd be kind of near the bottom of that cycle. Is that a fair summary of that?
I would say that's a fair summary. It's also like important to always remember that, like markets are way more complex, and this business cycle chart, and we'll have this posted up with the podcast charts, it doesn't always have to play out exactly the way it's drawn. Just because they're moving up and stocks and commodities are moving lower doesn't mean that stocks have to crash and that this is like some sort of final capitulation phase. It's just something to keep in mind. It's one piece of evidence that, hey, maybe we're near the end of this contraction cycle.
Yeah, for sure. We could see stocks higher from here and clearing 4180, the infamous 4180 level on the S&P 500. Absolutely. And these different trends or lack thereof that we see, that's why we want to be adaptive in our process. And guys, I want to highlight that we have our first sponsor of the podcast. Do you want to hear from these guys?
I'd be willing to.
You'd be willing to? Well,
I would be.
Yeah, it's no surprise that it's the Adaptive Select ETF that's sponsoring this podcast, and our clients are familiar with this as it's used in their own accounts. That's not an endorsement. That's not a recommendation. That's not means that others that are listening should buy it, but it does mean that Adaptive Select gets to have a commercial. And so I can sit here and say that Adaptive Select, which is listed on the NYSE under ticker ADPV, helps investors access 2 of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-753-3825. And I must add, as a disclaimer, investing involves risk, including possible loss of principal. This product is distributed by Quasar Distributors, LLC. There we have it, our first sponsorship of the podcast. Our clients are familiar with that product.
Yes.
The reason why that it's a valuable product, in our personal opinion, is just its capacity, that it's not just risk on all the time. Currently, it's on risk off mode, meaning because of the way the strategy operates, it's owning T-bills currently. Does that mean the market corrects from here? It doesn't. It just means that that particular strategy is identifying that it is a risk-off environment or a downtrending environment, and so T-bills need to be owned. That can change as soon as next week, but it's an important product that we use for our own clients. Maybe other advisors would like to use it, but we always have to be careful how we present it, because it's not a recommendation. Everybody listening to this is a big boy or girl, and they can make their own investment decisions. And with that sponsorship announcement, we are close to the end of our time. Anything else you guys want to cover before we close down this recording?
No, just to I guess echo on Pratty's business cycle. If we're using these 3 assets, I think he makes a good point of this doesn't have to play out in some super ideal, and no, it is very unlikely that it will play out in some very ideal and clear cut scenario. I mean, could you have a lot of commodities go lower, but oil doesn't, and thus commodity a lot of these commodity index are heavily weighted towards crude, but
Well, we can take crude out of it by using something like GCC, right?
GCC. So to that point, that's already broken down against IEF and is actually, I mean, pretty close to its. I mean, these would be multi-year lows essentially here, 2-year lows close of quote unquote equally weighted commodities versus bonds, and I'm not sure what that looks like. So IEF, similar.
Yeah.
Very similar. March, so 1-year lows essentially.
So, Pratty, how about you? I know in our show notes, pregame, you have something on here on the VIX. Did you want to touch base on that briefly?
Yeah, we talked about how it's been a liquid market sucking in both buyers and sellers, and that's just a reflection of the increased volatility we've seen. And I was looking at the VIX. I zoomed out a little bit, and I noticed that since 2018, there's a pretty well-defined uptrend in the VIX that we recently bounced off of. So, for the last 5 years, we've been basically in a rising volatility environment. It's just something that I noticed. I thought that was interesting.
No, that is really interesting. And I encourage anybody who has access to charts to look at that, because Pratty's pointing to that if you connect all the lows from 2018, 2019, 2021 through now, VIX is in a higher rate of trend. And another way to describe that is option premiums are higher, but also the daily moves of the S&P are higher. Kind of interesting to me. I was thinking about this the other night. The lack of overnight gapping in this environment, is that I'm not looking, you don't have to give me a definitive, is that surprising or not? But I find that interesting, considering when you look at VIX levels during the COVID crash or the 2018 period, you had some serious gapping overnight. I think we saw one maybe this week, but it's not a tremendous amount of gapping overnight. I don't know. Maybe that's surprising. Maybe it's not. It's just an interesting dynamic. Pratty, your point is valid. Increasing volatility since 2018, and that goes back to January 2018 being a mile marker that Ian and I have talked about in the past, that when we had Volmageddon, all those volatility products breaking up. And wouldn't you know it, Credit Suisse was one of the bigger providers of that product.
Oh, how about that?
Interesting. So back to January 2018, lots of people using volatility products or short volatility. Credit Suisse was a big issuer of those types of products. And here we are 5 years later, and it's still carrying reverberation throughout the markets. So I really appreciate both of you guys being on here. Always great education for me, and I'm sure for our listeners. Painting that picture again, we're still sitting in the middle of a 10-month range that's in size of 20%. We're seeing deteriorating breadth since the end of January. Clients are familiar with the write-up we sent out a week ago or 10 days ago that talked about the 3 steps that had to happen. Step 1 is we had to reclaim a 200-day moving average on most of these. We're sitting right there. That hasn't necessarily happened. We have to get above 4080 and 4180 in the S&P 500. Not there yet at all.
No.
That's why, when we look at how ADPV works, that's why it's holding T-bills. That's why there's high levels of cash on client accounts. Until we break above those levels and can start seeing an uptrend return, that's how it will remain. Any last items from you guys before we get out of here?
Yeah, to your point, I mean, this will be our 5th week sitting on a flat 200-day moving average.
Yeah.
So,
well, but yeah, between your point and Pratty's point about the sneak peek at what we're doing on a monthly basis, and then this week, massive indecision in the market, likely to see some move in a direction coming, but the characteristic of this market has been to pull in buyers and sellers and chop them up in a 20% range going back months. Pratty, awesome to have you on. Anything from you?
No, that would be all from me.
Awesome. Really appreciate it, guys. Thanks to everyone listening. Make sure you share this or give us a high ranking. It helps us get the word out.
Have a great weekend, everyone.